welcome to BloombergQuint. The big headline from today's monetary plus credit policy review was the comeback of a one-time restructuring scheme, which does not involve a downgrade of asset classification. There are some details that have come out on that as well. But let me bring in Abizer Diwanji of EY, who has been arguing in favor of this since this COVID crisis began. So, Abizer, first, let me throw a broad question to you on whether you think that this was the need of the hour and it's been done.
I think it was the need of the hour, not with any intent of hiding what the stress on the banking system is. Because if you've noticed, most private sector guys have already announced their capital raises. NBFCs have announced the capital raises. Government will support PSU banks in their capital raises. So I personally don't think this is going to be a capital issue. And I think that because disclosure requirements are already in place also, I don't think this was any view to hide anything under the carpet. But what is important is, if a one-time restructuring is done without classification, the system then is able to support revival of a standard company much better than an NPA company. So that's the only reason I preferred a one-time restructuring.
Okay, Abizer, let me start getting into details now. So the first thing that they have said is that this is available for a limited time period. So you have to restructure before the end of the year. So invocation will only be allowed till December 31st, 2020. And then attached to that, they say that only borrowers not in default for more than 30 days as on March 1 will be eligible. Both on the limited time frame, is that enough? And when they say not more than 30 days, meaning going all the way back since the inception of the loan, you should not have been in default for more than 30 days?
No, it says you should not be more than default of 30 days as at 1st March. So if you have a standard account, so you could be a standard account up till you are 90 days DPD, right?
Yeah.
So if most past due up to 30 days is when your restructuring is available to.
So you could have been in an NPA in the past, you would have become standard. As long as you were not more than 30 days overdue, you can apply for restructuring.
On 1st March, you should not be more than 30 days overdue. So if you've cured yourself in the past, it doesn't matter.
Okay. Is that fair enough? Is that enough of a check and balance?
Well, I don't think so. I personally am of the view that they should not have had this cutoff. Because one is companies which are impacted because of COVID. And second is companies whose revivals are impacted because of COVID. So there are companies who are defaulted, who are NPAs. But any hope or any chance of them getting a new investor or being able to come out of the crisis to do a revival are actually dead here because they will continue to remain NPAs. I think this differentiation between standard assets as at 1st March or not at 1st March was not necessary. Because everybody
essentially, they're essentially trying to, Abizer, say that this should be a direct COVID impact, and then they go on to specify that as well, right? So they're trying to say that this window is available to people impacted by COVID.
Yeah, this circular seems to say that people who are likely to turn NPA because of COVID or require a restructuring because of COVID are exempt. But my view is that every company is impacted because of COVID. There are companies who were well on a revival path, who were defaulted as at 31st of March or more than 30 days overdue on 1st of March. They themselves actually are going to find it very difficult to come around unless another scheme is coming out for them too.
Okay, understood. Let me just move on to some other aspects as well. So the other thing is that there is a committee that has been set up headed by Mr. KV Kamath. So it seems like it has a two-pronged role. First, it seems to suggest that they will recommend some sort of sectoral benchmarks, but they will also be involved in vetting the plan. So this is going back to the, sort of the bankruptcy committee model that somebody who is an outsider to the bank will vet these plans.
There was an oversight committee role. So, things to this. I think first of all, this sectoral benchmark is a brilliant idea. I think it will put a lot of companies in check, and it is a broad framework that you're giving somebody to say, listen, these are the benchmarks that we think or the expert committee thinks are right, and those actually will get people to think back and say that we should not have any frivolous restructurings. So I think people will fall in line with these benchmarks coming. Though I do think that if you have a oversight of every plan above 1,500 crores of total debt, I think that may create some bottlenecks because I don't know how the committee will then function unless the committee will have multiple specialist committees below it, and those it's an outsourced job, then it will work. But otherwise, I think potentially it could turn into a bit of a bottleneck, given that you have a invocation deadline of 31st of December, you have a 30-day ICA deadline, and you have an overall 180 day deadline.
No, absolutely. But first on the first part of sectoral benchmarks, what would these sectoral benchmarks look like? Give me a rough example. Do they have cutoffs in terms of what?
So
Growth, ICR?
I'll take one industry just as a rule of thumb. Take the construction business. If by outstanding claims on the construction business, there is the claims that are not on the balance sheet, for which I've a claim from the government from overruns or anything else, if that exceeds, say, on a rule of thumb, twice, if it exceeds more than twice the amount of the working capital that I have, then I know that that benchmark doesn't work.
Okay.
Because ideally what happens is, because I have claims on hand, those claims are funded out of my working capital, and that's why I default. I'm just taking one industry as an example. So ideally, there has to be some semblance to the claims outstanding to the working capital blocked up in the company. And if that isn't, then I know that there has been a siphoning of funds, and then that deserves a much different plan. Otherwise, what people will do is they will not factor anything that's coming out of claims and want to restructure all working capital for maybe 10 years, 12 years. I mean, we have the 2 year rule. But I'm just saying, people will tend to go berserk in these times, and in COVID times, it's quite possible for people to become extremely conservative because nobody knows when the revival will happen.
Okay, understood. So there are, as far as checks and balances go, what they are trying to do is a three-level check and balance. First, there is a sectoral framework. Within that, I presume the board-level policies will be set, and then each individual plan goes through a tick mark by this oversight committee.
That's correct.
Okay. What about the ICA frameworks that they have suggested? Again, they've said a certain amount of voting in favor in the case of consortium loans. These ICA processes have been notorious for getting dragged out.
Yeah, but there's a difference between the ICA process then and the ICA process as part of this circular. And the big difference is provisioning consequence.
Yeah.
Earlier in an ICA process, there was provisioning anyway happened, NPA anyway happened, whether you signed an ICA or you didn't sign an ICA. Now, if you do not invoke within the given time frame, and you do not sign an ICA within 30 days of such invocation, because the invocation expires at the end of 30 days, that company then is not in a restructured company and hence will not be able to get the provisioning benefit that is available. So I think now banks will become far more open to signing ICAs and open to resolutions because they want to get away from the provisioning now. So I think this time the ICA rule will be much more effective. And also there is a 75-60 rule that has come in terms of ICA acceptance.
Yeah.
So there's also a broad clause which was not there earlier.
Yeah, that's true. The provisioning on these restructured standard assets is adequate to your mind? It's not very high though.
Pretty much. I'm quite happy with that. I think 10% is a good number. See, it doesn't matter what 10% is. I'll tell you what will happen really is that if companies do not revive, say within 2 years, look at the backstop. The restructuring plan is only for 2 years. It says you cannot restructure anything more than 2 years from the original tenor. This is my reading.
Yeah.
So basically, every restructuring is stopped from going berserk beyond 2 years. What it also means that RBI has given you a 2-year breather. In those 2 years, if you do not end up refinancing that loan through another capital structure change, either from within the banking system or outside of the banking system, less likely within the banking system, but more likely outside of the banking system, you will in 2 years have to refinance a loan with a new facility altogether. So RBI is basically giving you 2 years to either prove yourself or hit the provisioning stack again. So for 2 years, you've been given this 10% provisioning holiday, so to say, which I think is pretty much required. In 2 years, if businesses cannot sort themselves out in terms of a new capital structure and a new business model, then frankly, the banks should take full provision, which they will.
Okay. Abizer, also tell me, so this post monitoring performance, they've said that there's a 30-day window of default that's been given post the restructuring. Explain to me what they're doing there. They're saying that after restructuring, if you default even for a 30-day period, then the restructuring gets nullified.
I have not been able to follow that well. So sorry, it's too early. But
No, fair enough. So, okay, let me now do what we were all doing before this to try and see whether the outcome of this will be very different from the outcome of the previous round of restructuring. What in the new rules do you think will prevent a return to very wide scale restructuring, which would be a sort of hiding of bad loans?
so there will be widespread restructuring because there will be widespread NPAs. There's no question. But I think that this time there are checks in place. The big check in place, I think, is the industry parameters, which will put a lot of plans into check and will not allow the hockey stick approach that was there in maybe 2008. Secondly, uh, because there's a 2-year norm, people will have to think as to what their at the end of 2 years, what is their plan going to be. I think it's going to force corporates to think faster because at the end of 2 years, then they will end up into the NPA rate again. So it's just a 2-year moratorium that's being granted. So that's different. Third is the fact that there is a provision exemption will force bankers to come together and think together in an ICA format. I think this is the single biggest mindset change to our banking community because I think uh, our borrowers are more than zealous to come and restructure loans. It's always been a banking community which has been at a lag to restructure. But I think now, just to avoid provisioning and make sure that their capital adequacies are maintained, banks will come forward and try and do restructurings.
Okay, but tell me, so the implementation part which you had flagged off earlier, it is a very tight deadline, right? We're in August now, so that doesn't give us very much time in terms of the committee being set up, the sectoral benchmarks, the individual plans being approved.
But see, the thing is that you have to invoke by 31st.
Okay,
So
okay,
you
okay.
get to 30th of June 2021, by which you can actually get the plans found up.
Okay. To your mind, and I will not hold you to the number, but give me a rough ballpark of the kind of debt you think that could come up for restructuring in terms of, you know, percentage of bank loans or percentage of stressed assets right now.
Uh, I can't hazard a guess. I can't hazard a guess. But
But there
I
would
do
be
think
significant demand for it. There is significant requirement for it. You heard from.
I think there will be. There will be because businesses are suffering. It's not for anything else. I don't think people are going to scamper to take advantage of this window. But the reality is that people will need time. They will need to alter capital structures. They will need to alter the cap tables and the debt equity ratios. And this is a good opportunity to do that. Only thing is people have to make sure that there is longevity in what they do. They should be able to at least reach to a stage where they can refinance their debt. A lot of people should today look for a good right debt equity balance to make sure that they get the equity, if not now, at least within a 2-year period. So I would love to see a lot more convertibles coming in from private equities to come and back good businesses, which will make sure convertibles happen at the end of 2 years, subject to a revival. So you don't go too cheap today. But there has to be every plan should look at a mezz structure or a junior debt or a convertible structure coming in as part of the restructure.
There is no bar in a previously restructured account coming back for restructuring now, is it?
If it is standard and if it is not overdue for more than 30 days on 1st of March, I would think it's eligible.
Shouldn't that provision have been there, though? I mean, we know enough accounts which are sort of perennial restructures. One comes to mind.
There are many, but the thing is, look at it. Just for one company that comes to your mind or five that come to my mind, we can't have policy. I mean, policy should impact the larger part, and we don't want unintended consequences. So I'm quite happy with let a few get away, but let the majority benefit. I'd be happy with
Okay.
that.
Apart from this, I don't know if you've had a chance to look at it, but and I haven't looked through the fine print either. They have provided for personal loan restructuring as well. That's an interesting add-on.
Yeah, they're differentiated between personal and non-personal, so to say, which includes everything else. So yeah, but a personal does not have, I think, all the nuances that it's a simple restructuring of a personal loan that is offered right now. As long as there is a decent plan in place, you can do it. So yeah, Personal actually, it does not include MSMEs, although MSME is not covered by the circular. I'm more intrigued at, and I think this is my interpretation, correct me if I'm wrong, that financial institution restructuring is not covered in this.
No.
Now, the financial institution itself will restructure its asset side, but it will not be allowed to restructure its liability side. Now, this is okay for banks, but think about NBFCs.
But it's the same principle that existed with the moratorium, right?
Correct, but how will the NBFCs then, if the NBFCs are going to go ahead and restructure their asset sides, personal loans, for example, how are they going to meet their asset liability gap? Because the banks are not going to restructure them unless there is specific liquidity or incremental funding that NBFCs are able to get. I think they will fall into a liability trap.
Fair enough. All right, Abizer, just to sort of wrap up, anything I've missed on important points in the circular that you want to highlight, or things that have been left out that should have been included?
Ira, both of us ran to read the circular, so I think we know as much as each other would.
All right. But thank you, Abizer. Thank you for this quick chat. We will come back to you later for details. Thanks for watching Bloomberg. Quick update on the restructuring circular. Go to the website, though. We'll have a lot more detail there.